Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 284 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today we are going to be talking about what is coined as the 12 Pillars of Wisdom. Okay, and this is something that it was a set of remarks by John Bogle, or Jack Bogle, as many have come to know him, who has passed in recent years, and he is one of the best investment minds out there, and should be listened to, should be taken into consideration when you're making investment decisions, or you're trying to learn about your investments. Jack Bogle is a great place to look. And he gave these remarks and left these 12 pillars of wisdom. And I think they provide a lot of context for us, provide a lot of good wisdom, even still 20 years after they were made. And so hopefully these can provide you with some good wisdom about investing and help you to make better investment decisions. So stick around for all that and some of my commentary on it and more in today's episode. Before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long-form episodes on YouTube and the podcast every single day. And if you need somebody to build a financial plan for you and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals, and then ultimately push you on towards long-term financial freedom, which is what I hope for every single individual who watches or listens to the show on a day-to-day basis. Now, these 12 pillars of wisdom, they are relatively straightforward, okay? They aren't something that's just super complex. They're not things that are going to absolutely blow your mind, okay? But if you are able to listen to them, then you can make a lot of good decisions in your financial life. Because something that is the backdrop for this particular set of remarks that Jack Bogle made is that it was lessons that we should have learned before the bear market arrived, but are only learning now. Okay, so 2001, they had just seen a bear market come through in the wake of the tech bubble. And this is something that I think is really important, because if you get some good investment advice during a bear market or right after a bear market, right? If we learn from bear markets, then we'll be able to learn how to make good decisions even in bull markets, right? Because when you see bear markets occur, they humble you a bit. They put you in this mindset where you're able to make decisions that are a bit more risk averse than you would be otherwise, right? They make you think about your decision making a little more. And these, pieces of wisdom, these ideas are going to be extremely useful. Almost all of them will be extremely useful to you in your investment life. So I don't want to stall much longer. I don't want to add too much commentary beforehand. Let's just jump right into the 12 pillars of wisdom. Pillar number 1 is that investing is not nearly as difficult as it looks. The intelligent investor in mutual funds, using common sense and without extraordinary financial acumen, can perform with the pros. In a world where financial markets are highly efficient, there's absolutely no reason that careful and disciplined novices, those who know the rudiments but lack the experience, cannot hold their own or even surpass the long-term returns earned by professional investors as a group. Successful investing involves doing just a few things right and avoiding serious mistakes. I think this is a great piece of advice, because this really speaks to all the individuals that I am trying to speak to on a day-to-day basis on the show, right? I'm speaking to the novice. I'm speaking to those who may just know a little bit about investing. And if you just know a little bit about investing, that is okay, right? But you have to understand that even if you just know a little bit, you can compete with the big boys. You can get out there and actually maybe even surpass the big boys if you do things in a proper way, if you have a set of principles that you follow and you don't stray from those principles far too often. Okay, investing is not that hard. Okay, it's so many people do it, you should expect that it's not that hard. It does not take a genius to invest and make adequate returns, and you shouldn't think that it does. I don't want you to think that it does because that just pushes more people out of the market. I want you to know that you can get involved involved in financial markets, and you can be successful as long as you just have some basic knowledge. And I try to provide that basic knowledge, and I provide you with even more than basic knowledge on this show on a day-to-day basis. So you don't even need to know everything that I say, right? But I do try to provide you with a lot of these quote-unquote rudiments that will allow you to make good investment decisions as you move forward. So pillar number 1, investing is not nearly as difficult as it looks. Pillar number 2, when all else fails, fall back on simplicity. There are an infinite number of strategies worse than this one. Commit over a period of few years, half of your assets to a stock index fund, half of your assets to a bond index fund. Ignore interim fluctuations in the net asset values. Hold your positions for as long as you live, subject to only frequent and marginal adjustments as your circumstances change. When there are multiple solutions to a problem, choose the simplest one. Okay, so here we have a remark by Bogle. Again, these are not my suggestion. This is something that Bogle said, right? He's saying, when all else fails, just make it easy on yourself. Do something simple. Do something very easy. I've told you guys many times that just investing in index funds can be extremely useful. It can be extremely valuable to you, and you don't have to go and pick individual stocks. In fact, you should not go and pick individual stocks unless you have the knowledge and the wherewithal in order to do so, and the mind and the patience to do so. Right? Most people should not be picking individual securities. They should be buying index funds. They should be buying things like stock index funds and bond index funds and things of the like. Now, he's saying go half and half, go 50-50 on stock and bond index funds and just leave it be. I don't think that everybody should go 50-50. Okay, I think you can be a little less simple than that, but he is right. When all else fails, if you just go 50-50 and hold it for as long as you live and make very few changes and just feed it over time, you're going to end up making some good rates of return, some adequate rates of return. Nothing like holding a complete stock portfolio, but nonetheless, you'll make decent rates of return, and you will allow yourself to grow your money over time. And you'll do better than those who sat on the sideline, and you'll do better than those who just saved in cash, and you will build some semblance of wealth for yourself if you save enough over time. Okay, so he's not wrong. Simplicity is truly a gift. Simplicity is truly magical if you allow it to be. If you don't get too crazy, if you don't try to make it harder than it has to be. And investing does not have to be hard. Again, investing can be very simple. And if you don't know anything about investing, you can take on this ideology and you will likely be just fine. As long as your rates of investment over time are high enough, you will be perfectly fine. Pillar number 3, time marches on. Time dramatically enhances capital accumulation as the magic of compounding accelerates. At an annual return of 10+%, the total value of the initial $10,000 investment is $108,000 at the end of 25 years, nearly a tenfold increase in value. Give yourself the benefit of all the time you can possibly afford. Okay? And this is very relevant to what we've talked about on this show, at least as of recently, right? I talked yesterday about the importance of being able to invest over a long period of time, because the longer you invest, the more you'll be able to accumulate, right? Now, because money does grow on this exponential upward curve, right? If you make, let's say, 10% and you've got $10,000 in your account, right? That's going to leave you with $11,000 at the end of the year. But if you make 10% and you've got $1 million in your account, that's going to leave you with $1,100,000 the next year. So you can see that as your money grows, it grows in a faster way. Okay, now it's going to take the same amount of time for your money to double, making 10%, whether it's at $10,000 or at $1 million. But 10% on $1 million is $100,000, and 10% on $10,000 is only $1,000. Okay, so there's big differences in the amount of money that you can make given more time, given more growth of your money. And so allow your money to grow for as long as possible. Stay in the market, get in early and stay in late, right? I'm not saying don't ever stop working. I'm just saying, if you want to retire early, do it by investing more. Don't do it by rushing your ability to invest, rushing your ability for your money to accumulate over time. Because the most valuable thing that you have on your side, if you're young enough, is time. And if you have time and you can use your time properly and you can allocate your capital over a long period of time, then you will be extremely successful with your investing. So time does march on, just march on with it. Okay, so that is the third pillar of wisdom. Fourth pillar, nothing ventured, nothing gained. It pays to take reasonable interim risks in search for higher long-term rates of return. The magic of compounding accelerates sharply, even with modest increases in annual rate of return. While an investment of $10,000 earning an annual rate of return of positive 10% grows to a value of $108,000 over 25 years, at positive 12%, the final value is $170,000. The difference of $62,000 is more than 6 times the initial investment itself. Okay, so it does pay to take some reasonable risks, right? This is why I tell you guys it's okay. It is okay if you have the time to take more risks. It's okay if you are younger to try to invest in things that are going to make higher rates of return over time, right? Because you do have time to make up for the potential downside, and you're not somebody who's going to need the money anytime soon. So if the risks do come to bear, right, then you're not going to need to take the money out. You can ride out the risks and move to the other side and hopefully still make really great rates of return. Okay, so putting your money, for instance, into mostly stocks, right, or putting it all into the stock market, right, putting all of your invested capital into the stock market is not necessarily a bad thing. And it's not something that is likely to hold you back over a long period of time. It may be something that you are afraid to do, and it may be something that you don't necessarily want to do because you are particularly risk averse, right? But if you take some reasonable risks, and I would say that is a fairly reasonable risk, you can get some really good payouts over a long period of time, right? And if you don't venture, if you don't try, then you're not going to gain anything. And I'll take this pillar even a step further. Nothing ventured, nothing gained. If you're not putting aggressive amounts of money away into your investments, and that is once you've built up your financial foundation, you have emergency fund, you have your debt paid off, all these different types of things. If you're not putting aggressive amounts of money into your investments, then you are not venturing, right? Nothing ventured, nothing gained. You aren't trying to get to this point where you can live out your financial freedom dream. So I think you should be investing aggressively and taking a few more risks as far as trying to get higher rates of return, but take reasonable risks. Again, these aren't supposed to be risks that are just crazy, and they're not supposed to be risks that may not pay off and are too detailed of risks. Again, risks that are diversified can pay off over the long term and likely will pay off over the long term. But risks that are extremely pointed, so like buying one small company stock with all your money, that is that's a riskier risk, right? That may be an unreasonable risk to take. Okay, but nonetheless, nothing ventured, nothing gained. Get out there, try it out. Then, pillar number 5, diversify, diversify, diversify. By owning a broadly diversified portfolio of stocks and bonds, specific security risk is eliminated. Only market risk remains. The risk is reflected in the volatility of your portfolio and should take care of itself over time as returns are compounded. As the bear market of the past year, remember he was making these comments back in 2001, as the bear market of the past year makes clear, investing in stocks is risky. And we actually saw that last year during the coronavirus crash, that investing in stocks is risky, right? Crashes do occur, okay? But being diversified, so whether you have a stock fund that is diversified over many different types of stocks, or you have a bond fund that's diversified over many different types of bonds, or you hold a balance fund which tries to keep a certain asset allocation of stocks and bonds, right? Diversifying is extremely important, especially with the vast majority of your money and any money that you're putting away for retirement or anything like that, because this money needs to be there and it needs to, have the smoothest path upward possible, right? And a good way to do that is to get rid of that unsystematic risk, they call it, or that risk that is specific to the security, right? And only take risk that is relative to the market, right? So it is okay to take some single stock risk. I've told you before, investing in single stocks is something that I do and is something that is okay. Now, do I do it with the majority of my invested capital? Absolutely not, right? The majority of my invested capital is highly diversified into stock index funds, okay? I just simply understand that the risk of diversifying is less than the risk that I'm taking with buying individual stocks. And I'm okay with both of those risks, but in their proper place and in proper percentages of my portfolio over time. And diversifying will allow you to be in a position where you're not afraid to add more money when the market goes down, right? It's very difficult to add more money to a stock that's going down because you don't know how far down that stock's going to go. But with the market, you have some general consensus and some general idea that buying the dips is going to work over a long period of time. But with a stock, you don't know if buying the dips is going to work over a long period of time. Yes, you can do your research and you can have a thesis about a particular stock. But stocks are far more volatile, individual stocks that is, are far more volatile and far more uncertain in their movement than is the stock market as a whole. Okay, so diversify, very important. Pillar number 6, the eternal triangle. Never forget that risk, return, and cost are the 3 sides of the eternal triangle of investing. Remember also that the cost penalty may sharply erode the risk premium to which an investor is entitled. You should understand unequivocally that investing in a fund with a relatively high expense ratio, more than 0.5% per year for a money market fund, 0.75% for a bond fund, or 1% for a regular equity fund, bears careful examination. Unless you are confident that the higher costs incurred are justified by higher expected returns, select your investments from among the lower cost, no load funds. Now, this is very, 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 very good wisdom that we have here from Jack Bogle. It is a great thought. And I would even say that given that this was in 2001, we can adjust this downward a little bit, right? I think that the expense ratios that he stated are still too high. I think that expense ratios can be far, far lower for us today. I think we should look for expense ratios even on equity funds that are less than 0.5%, right? I don't think that there's way too much of a risk premium that is being created by funds that are offering anything greater, right? Anything greater is just going to eat away at returns over time. If you look at most index funds now, and the cost of investing has decreased markedly since 2001, you look at most index funds now, we're talking 0.04%, 0.05%, or no expense ratio at all. Right? I know for sure that Fidelity, and this is not an endorsement, this is just saying that I know that they have this. I know that Fidelity has an S&P 500 fund that has no cost, no expense ratio, and a couple other funds that have no expense ratio. Right? If you can track the exact same index and you can do it for free, why would you not do that? Right? Why would you pay, 0.5%? Why would you pay 1% for something that's going to perform just like this index, and you could buy into the index for free? Saying that you would pay 1% for an equity fund means that you are sure that that equity fund would provide at least 1% more per year in returns than the S&P 500 over the long term. And it's going to be extremely hard to find a fund that will do that, right? There are some funds that have and some funds that will, but picking out which ones actually will and will do so sustainably. I'm not saying over 1 year. I'm saying over 30 years and 40 years. Finding ones that will do it consistently is almost impossible. Okay, so we have to understand that risk and return are very real. We have to understand risk and return. But if we don't pay attention to costs, right? If we don't pay attention to how costly it is to invest, then that may be an issue. Because here he's talking about just expense ratios. Well, what about if you're investing in funds that have loads? Well, you shouldn't be investing in funds that have loads because there are far too many no-load funds out there now that will perform just as well. Then, what if you're paying an investment advisor or some broker, some percentage of your assets under management every single quarter? That's going to eat away at your returns as well, right? We have to understand all these things that are going to eat away at our returns, right? And understand that in order to make up for those things eating away at our returns, we would have to take more risk. Okay. And ultimately what it comes down to is that if you have such high costs that you would have to take such high risks that may not be within the realm of what you should be taking as an individual investor, then you may need to rethink the way you're investing. Ultimately, you can invest with almost no cost today. And if you invest just in a no-cost index fund, then you can invest at absolutely zero cost and be perfectly fine over the long period of time and make likely better returns than most individuals who would invest in like actively managed mutual funds or mutual funds that do have higher expense ratios and loads associated with them. Okay, so understand that eternal triangle of risk, return, and cost. Then, pillar number 7, the powerful magnetism of the mean. In the world of investing, the mean is a powerful magnet that pulls financial market returns towards it, causing returns to deteriorate after they exceed historical means by substantial margins and to improve after they fall short. Reversion to the mean is a manifestation of the immutable law of averages that prevails sooner or later in the financial jungle. So ultimately what he's saying here is not that stock prices are going to come back to some mean, but stock valuations will come back to some mean over time. And this is generally true, right? It's generally true that this is the case, but it is also, very hit or miss in trying to figure out if, it's always going to revert to the same mean or just in the same range, whatever it may be. But we do need to know that any returns that we get that are just outsized and that don't make sense, right, are likely going to be followed at some point by some returns that aren't as great. Or if we get a lot of returns that aren't so great, they're likely to be followed by some good outsized returns at some time. Now, it's not clear when those returns will happen, good or bad, but it is sure that as long as the economy grows at a certain rate and we get paid dividends or have stock buybacks as a certain percentage of whatever these companies are worth that we're investing in, right, then we are likely to come back to some mean of investing returns over time. And you have to understand that if we get, too overextended, which some argue that we are at this particular point in time, if we do get too overextended, then you may be set up for a downfall. So just be understanding that things like to revert to the mean and that stock market valuations are no different. Pillar number 8, do not overestimate your ability to pick superior equity mutual funds, nor underestimate your ability to pick superior bond and money market funds. Okay. So in selecting equity funds, no analyst of the past, no matter how painstaking, assures future superiority. In general, you should settle for a solid mainstream equity fund in which the action of the stock market itself explains about 85% or more of the fund's return, or a low-cost index fund, right, which is 100% explained by the market. But do not approach the selection of bond and money market funds with the same skepticism. Selecting the better funds in these categories on the basis of their comparative costs holds remarkably favorable prospects for success. Okay, so I'm going to lean a little bit more towards the equity funds here because I think it's just more pertinent to our investing lives, especially today when bond yields are extremely low. And I'm not saying you shouldn't ever invest in bonds. That's not what I'm saying. I'm just saying investing in a low-cost bond fund and a low-cost equity fund are very similar in the way that you would go about selecting them. But ultimately, what we're getting at here is that no particular fund, no matter who is at the helm, is going to just blow the market out of the water on a predictable basis over time, right? So picking one that is highly explained by the market, meaning that the returns and the way that it moves is very similar, the correlation is very similar to that of the market, is typically a good pick, or just buying a low-cost index, which if you're going to try to find something that correlates highly with the market, why not just buy a low-cost index, because the cost is likely lower anyway than the actively managed fund. Okay, so don't overestimate your ability to pick superior equity mutual funds. It's just not likely going to work out for you over time. Pillar number 9, you may have a stable principal value or stable income stream, but you may not have both. Contrast a money market fund with its volatile income stream and fixed value, and a long-term government bond fund with its relatively fixed income stream and extraordinarily volatile market value. Intelligent investing involves choices, compromises, and trade-offs, and your own financial position should determine the most suitable combination for your portfolio. Okay, so this is just saying if you're picking between these two different choices for fixed income portions of your portfolio, you have to balance volatility versus income. Okay, this is still a good piece of wisdom, but not necessarily as relevant to us today as some other things may be. Pillar number 10, though, I think is a very, very good pillar. Beware of fighting the last war. Too many investors, individuals and institutions alike, are constantly making investment decisions based on the lessons of the recent or even the extended past. They seek stocks after stocks have emerged victorious from the last war, bonds after bonds have won. They worry about the impact of inflation after inflation, having turned high real returns into so-so nominal returns, has become the accepted boogeyman. You should not ignore the past, but neither should you assume the particular cyclical trend will last forever. None does. Okay, this is a great piece of advice, right? Because we do fall into this path, especially right now. Just think about the market right now. Right now, bonds are, I just said it a moment ago, bond yields are extremely low, right? And so not a lot of people are interested in investing in bonds. Stocks are the soup du jour, right? Stocks are the thing that most people are interested in at this particular time. People are worried about inflation because inflation has been high. Right? And that they're worried about the Fed because the Fed's been pumping money into the economy and keeping rates low and these types of things, right? We can't just assume that because something is happening right now or something is working right now that it will continue into the future, okay? We have to understand that cycles occur, right? Which I think this would be a great time. I'll just put a quick plug in for Howard Marks's book, Mastering the Market Cycle. He does a great job of talking about cycles and how to deal with cycles in your investing life. But we have to understand that stocks aren't always going to be as victorious as they are today. Inflation is not always going to be the same as it is today. Maybe it'll be more pervasive or maybe it'll be less. Bonds aren't going to be as much of a no-no investment as they are today, right? So don't fight the last war. Don't sit around and just worry about the things that have recently happened. Look to the future, right? Understand that things are going to change. And if you're investing in a simple way, you don't have to worry about the last war or the next war or whatever. Understand that over the long term, you're going to make the average returns of whatever you're buying in at, and you're going to be perfectly fine in your index funds, okay? Pillar number 11, you rarely, if ever, know something the market does not. If you're worried about the coming bear market, excited about the coming bull market, fearful about the prospect of war, or concerned about the economy, the election, or indeed the state of mankind, in all probability, your opinions are already reflected in the market. The financial markets reflect the knowledge, the hopes, the fears, or even the greed of all investors everywhere. It's nearly always unwise to act on insights that you think are your own, but are in fact shared by millions of others. You have to understand the market is pricing in the future, not the current and not the past. Okay, the market is always looking forward. That's why so many people were flabbergasted last year. They were like, how's the stock market going up and the economy so bad? Well, the stock market crashed very quickly, right? Because it was trying to price in all the information that it had. And then it was immediately looking forward and it was immediately growing with the companies that were doing well. Look, I have no doubt that I've looked at the market in a way that, I know something that they don't, and something's not priced in and it should be, or inflation isn't priced in and it should be. Inflation is priced in. Now, is it priced in to the extent that it should be? Maybe not, right? Is anything priced in to the extent that it should be? Maybe not, but the market corrects itself extremely quickly if it is wrong, if it finds out that it is wrong about some particular indicator that is, one that the market actually trails behind, okay? So, you have to understand that you don't know that much more than anybody else. You don't know that much more than the market as a whole. You may be able to find good places to invest that will allow you to, kind of work in a niche that maybe, the market hasn't come to light on yet, or something's out of favor. Out of favor is a very real thing, but that doesn't mean that what's being priced in is necessarily wrong, or that you're pricing in something that nobody else is. It just means that maybe you're early, or maybe you could also be late. Then pillar number 12, and I preach this to you guys every single day, think long term. Do not let transitory changes in stock prices alter your investment program. There's a lot of noise in the daily volatility of the stock market, which too often is a tale told by an idiot full of sound and fury, signifying nothing. Stocks may remain overvalued or undervalued for years. Patience and consistency are valuable assets for the intelligent investor. Best rule, stay the course. Okay? This could not be more true, right? The market can stay overvalued for a long period of time. And that's why I hate when I hear individuals talk about, we have to have a correction. We haven't had a correction in a long time. Well, who says? Who says we have to have a correction? Yes, history may tell us that we have a correction on average once every year, but that doesn't mean that it has to happen, right? That doesn't mean that the market can't stay overvalued for some period of time. And just because people want to buy the dips doesn't mean that the market doesn't stay undervalued for some period of time, okay? So you have to understand that the market kind of has a mind of its own, and as long as you have an investment program where you're systematically buying at low prices and at high prices, and you dollar cost average your way in, you will be perfectly fine if you just remain long term. Understand what the long-term average returns are and what you should expect from what you're invested in, and just look towards those averages, look towards those returns. Don't worry so much about what happens in the short term. You may make 30% one year, you may lose 30% some other years, because that has happened. 2008 did happen, right? But you have to understand that one way or the other, stick to your guns, stick to your investment program, stay the course, and that will be best for you over a long period of time. So I think these pillars of wisdom are great and will be helpful to just any investor out there. And obviously Jack Bogle is a big investing hero of my own and of a lot of individuals out there. So just take these to heart. Think about these.